As a founder of a startup, there are many things you need to master when starting out. Luckily, accounting is an area where you do not need to be an expert. Most startups hire an accountant or outsource accounting work to an external service provider from the outset. That being said, you do need to have an overall understanding of how your accounting system works and how it can help you manage your company and communicate with your stakeholders. The first transactions that you will have to record when starting up may occur even before your startup has been legally established. Such transactions are typically paid out of your own pocket and may be reimbursed once capital is raised. At this point, you may simply make basic manual bookkeeping or use a spreadsheet on your computer. But as your startup begins to grow, you will have to select a software program to assist you keeping track of your income and expenses, cash, inventory, payables, and receivables, as well as generating meaningful finance reports. There are many professional accounting software products available. Some come with advanced functions and are very expensive. Other simpler products are open source and free to use. Regardless of which accounting software you choose, your accounting system will be built up based on one general account called a general ledger account. This is where all of your transactions are recorded, whether these are related to income, costs, investment, or financing, and whether or not such transactions are in cash or other form. This account can be compared to one general bank account for all your transactions. Imagine you wanted to print out an account statement from this general ledger account in a company with many transactions. That could be a very long roll of paper, and you would have big trouble getting an overview of what expenses were paid to whom. In your accounting software, you can set up a different sub-account of the general ledger account for each category of transaction you want to monitor. A smaller company would typically have at least 20 such sub-accounts for expenses, while a larger company could have hundreds. Before setting up these sub-accounts in the accounting software, you need to make a table of contents. In professional language, such a table of contents is called the chart of accounts. Think about it as an organization chart for a physical filing system. As soon as your accounting professional has set up your accounts in the accounting software, it's time to begin to key in every transaction that occurs. One category of outputs from your accounting system is the account statements from individual accounts or sub-accounts in your system. Other outputs are the three classic financial summary reports. The first one is the profit and loss statement. It shows a summary of all your income and expenses for a given period, categorized under different headings. It also shows your gross and net profit. The second summary statement is the balance sheet. It shows you how much your company owns, its assets, and what it owes, its liabilities, at a given point in time. The difference between assets and liabilities in the balance sheet is what belongs to the shareholders, and it is referred to as owner's equity. The third and final summary statement you need to understand is the cash flow statement. It shows a summary of how cash flows in and out of your company and how much cash you have on hand. These summary statements reflect how the company performs and its economic health. They are reviewed periodically by the management, board of directors, and owners of the company and form an important basis for decision-making. Also, banks and potential partners and investors may request to see these statements. There are many great tutorials teaching accounting basics online, and if you don't already understand the basics, you may take advantage of these open-source learning opportunities.